Yeah, I mean, it goes back to what's the underlying first principles in my portfolio, and actually what I recommend to people if they don't have weird behavioral or institutional baggage. Evidence-based, long-term, robust to chaos, right? And then for me in particular, I got to have skin in the game. Just so yeah, that's just part of the deal of being in our business. That's not obviously something that other people have to deal with because they may not be an asset manager, but it's that simple. Evidence-based, long-term, robust to chaos. Nowhere in there does it say strong relative performance to the S&P 500 over the next year, right? It doesn't say it doesn't say career risk focus. It doesn't say tracking error centric. It doesn't say, anything that pretty much everybody focuses on, because that's irrelevant to what my first principles are. And so that's why this portfolio, it doesn't look anything like anything that you would ever see in the standard, hey, buy 60% S&P, 40% bonds and call it a day. That's just crazy. And unfortunately, people are learning that, being long S&P 500 60% and long treasuries 40%, which was the greatest hedge fund 2.0 Sharpe ratio strategy over the last 25 years, like, it's not that easy, right? And this year you're down 15 to 20%, and your future looks pretty miserable. Just because I think it was a unique period where everyone who did that was, the best hedge fund manager of all time. And I can't see that repeating probably ever again in the future of investing. That seems nuts to me.
Welcome to Excess Returns, where we focus on what works over the long term in the markets. Join us as we talk about the strategies and tactics that can help you become a better long-term investor.
Justin Carbonneau and Jack Forehand are principals at Validea Capital Management. The opinions expressed in this podcast do not necessarily reflect the opinions of Validea Capital. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Validea Capital.
Hey guys, this is Justin. In this episode of Excess Returns, Jack and I talk with Wes Gray, founder and CEO of the quantitative investing firm Alpha Architect, and also of ETF Architect, a firm that helps bring new ETFs to the market. This is our second Show Us Your Portfolio interview, where we talk with Wes about his investing objectives, how he manages his personal portfolio, and what we can learn from his perspectives and positioning. This is another episode that might be best watched on YouTube, since there are a few charts that we reference. As always, thank you for listening. Please enjoy this discussion with Wes Gray of Alpha and ETF Architect. Wes, thank you for joining us today.
Appreciate you guys having me. Look forward to it.
This is the second time you're on with us. The first time I think we were geeking out around the value momentum factor, but today we're going to do something different with you, something I think that's going to be fun and we're going to enjoy, and we're going to talk about how you go about managing your own personal portfolio and how you think about your own investment strategy. And I think given just your experience in the markets, given the sort of the uniqueness of the business you're in with the ETF business, as well as other things you're doing in the investment space, it'll make for an interesting discussion as we sort of look under the hood and talk through with you how you go about managing your investment portfolio. So I guess to start, I'm going to put my financial advisor hat on here, and Wes is my new you're my new client.
I love it.
So we're going to take the 10,000 foot view question. So when you think about your biggest long-term goals and really what you're trying to achieve with your investments, I mean, what are the goals? Is it a great retirement? Do you want to leave the money to your kids and your family? Is it just overall peace of mind? I mean, what's the overarching objective here?
First off, I just want to thank you guys on behalf of Miss Katie J. Gray, because I don't have a financial advisor, and she's always trying to tease all these things that you're about to ask me out of my head, because I kind of manage all the investments and everything. So this will be great because it forced me to actually write all this stuff down and do what you're supposed to do as a family, but what I always preach to people but don't actually do myself. So I appreciate you guys just at the beginning of being my financial advisor here and forcing me to think through this. So I kind of...
You'll get the bill after.
Yeah. Give me the bill, and you can go argue with Rick Ferry over whether we should charge on AUM or fixed.
Yeah, AUM fee all the way, baby.
Okay, sounds good. We'll have to argue whether Alpha Architect equity value is in there or not, but all good. So I kind of break it down into like big blue arrow ideas and then what I call tactical goals, like things I can actually wrap my head around. So for me, like the big blue arrows are just not having to stress about money, right? Like, so I grew up broke, was on the free lunch program, didn't have shit as a kid. It just, my whole life was just trying to figure out how do I not have to stress out about this. So just not having to stress, peace of mind is a big thing for me. The other one is being able to fund our business. So, you know, we're kind of all in on Alpha Architect, and I like my team. I like what we've built, and, you know, we're in a business that has a lot of volatility. So I just want to have enough capital on the personal side where, to the extent, you know, things get rocky or crazy, you know, we don't have to fire people. Like, we can keep on building and keep on maneuvering, just because I think it'd be a shame if, you know, a financial distress event somehow affected Alpha Architect. And then kind of the last one is just, you know, blocking and tackling, like make sure we can retire and like pay for the kids' college, which is obviously getting more and more expensive. Those are kind of like the big blue arrow ideas, and those could change, who knows. And then what I call is the tactical goals. These are things that are tangible to me that I can kind of grab onto. The first one is like not having to cheap out on flights with 3 kids. So, you know, instead of taking the 3 connections to go to California, maybe I take the 1 connection and the non-red eye, and I pay an extra 50 or $100. Like, not having to worry about that is awesome, right? So I'm not at Learjet level, but I'm at, let's not red eye this thing. That's awesome. The other thing is like healthy food and nutrition. So I want to be able to go to Costco and buy whatever the hell I want in bulk, even if it's more expensive than like the less healthy version, just because, you know, I value, you know, trying to take care of my body, and same with the fam. And then the third one, kind of related to that, is being able to afford things that I guess motivate or help encourage activity and exercise for my family. As you guys know, I don't need that because, you know, I don't really need extra motivation to go work out and stay in shape, but a lot of people do. So if I can, you know, get lessons, if I can get special gear, whatever it takes to kind of get people motivated, I want to be able to spend on that. And then kind of the last one is just the ability to host like cool parties and good community events where no one has to worry about the cost because I can just float it. Just because I always think that's fun, right? Like, you get to go to a big get together. You don't ever have to sweat about like the cost of it. I just would rather people just focus on having fun. So anyways, those are kind of like my big blue arrows and like my tactical goals of what I like about, you know, if I had capital, which I do now. I like these things.
Yeah, I love that. It almost seems like it almost seems like there's like military sort of strategy and tactics like embedded in there. You have, you know, your overall strategic objectives and then the tactics to get you there.
Yeah, I do, because I used to be in the military, and you get tired of hearing generals say, "Oh, we're gonna win in Iraq." Oh, well, that's damn near worthless. Like, how about what are we going to do on this patrol through the palm groves to go from A to B? And like, who's got the ammo? Who's got the guns and the rifles? And who's got like the QRP? So I just naturally, you know, I understand you got to have big blue arrows, but I like tactical because it's just much more tangible to me. So that's why it's set up like that.
You know, you mentioned retirement, and I can't imagine you're like going to be the type of guy like just sitting on the beach somewhere. I think the beach will be part of your retirement, just given where you are, where you reside and where you live. But you know, when you
it already is my retire. I'm already retired by that measure.
Yeah, nice. But how do you, you know, I guess when you think about your retirement, I mean, do you intend or hope or plan to work for forever, for as long as you can, or do you kind of envision there being maybe a point in your life where it is, you know, being more retired and doing whatever retired people do?
Yeah, so I've had the last few years, I've kind of thought hard about this, and I'm at a stage now where, you know, my on paper assets and my actual assets, you know, I probably got more money than I ever know what to do with. But my problem is I actually kind of like our business and I like our team. and I actually like what we're doing in the marketplace. I mean, all day long, I get to talk to investors and ETF entrepreneurs. Like, that's what I like to do. Like, I would do that for free. So I would always like to kind of be involved in the business side of things to the extent that I'm actually able to add value. I don't want to be like the old guy who's a big waste of time and thinks he's cool, but assuming I can still like add value for the business or thing. And I'm not stressed out about life, and I still have the opportunity to be flexible, be with my family. I mean, why not, right? Like, as long as it's not causing me a lot of angst, and I got good teammates and people that can help, deal with shit that I don't want to deal with anymore. I'd kind of like to stay engaged and, keep the dream alive as long as possible, for sure.
Yeah, nice. I guess at a high level, how would you classify your approach to investing when you're looking at it from, a wide angle?
So my personal portfolio, it's kind of like ties to like our core beliefs as a firm, frankly, but basically evidence-based, long-term, robust to chaos, and then what I call skin in the game, right? So evidence-based in the sense that, I don't want to be what I talk trash about every day, the maniac behavioral person. So everything we do is got to be based on my best assessment of the overall evidence out there, for or against like a given approach. The other thing is long-term, same thing. Like, there's a lot of stuff that's evidence-based, but it requires horizon and discipline to stick with it. So I anchor on that. And then the other one is robust to chaos. What the heck does that mean? Well, as you guys know, we're in the asset management business. And so I'm not here to be a mean variance optimizer. I need to kind of focus on, hey, I have assets that are built to compound, and I know they're super risky. But so I need to have other assets that mechanically will work on average or most of the time when the what hits the fan. So I need to really think about tail risk management a lot more than, well, probably everyone should be, but in my case, I need to think about even more because so much of our business is tied to what the market does. And then kind of the final thing, which is also somewhat unique to just being an asset manager, is it's all about skin in the game, where I just believe that if you're charging people, fees, and you're asking someone to put their own money that they worked their ass off their whole life to earn, you should probably invest in the same things that you're telling other people to invest in. So I'm just, even though that's not really commonplace in our business, and you can make fancy arguments of why that's stupid, because you don't want to invest in your own products because they're correlated to human capital, blah, blah, blah. But I just feel like it's bad leadership to not have a lot of skin in the game, because, that's just what you should probably do. So those are kind of ideas: evidence-based, long-term, robust to chaos, and having skin in the game.
I want to start with maybe the major asset classes you invest in, and I guess your wife will also be happy with us because I think you've put together a pie chart where you've actually sort of outlined the major different things you're currently invested in. So could you maybe just talk about, just at a high level, the major asset classes you invest in?
You got it. So I sent you guys that, and you're right. Katie's going to be quite happy that I actually put this in a nice organized picture. We do have this, but it's not in a nice picture. It's with like 100 commodity futures contracts running around. She's like, what the hell is this? So basically cash, right? Real estate, which in my case, like my residence. And I'll tell you about why that's unique to Puerto Rico in particular. Tail risk, so like direct tail risk products that just essentially buy puts. What I call private short term. So I do a lot of like weird like distressed deals or lending to people that are short term and opportunistic, especially down here in Puerto Rico. What I call trend equity simple. There's an ETF, it's like the simple way to like get access to global factors with trend falling. I use that. And I also have trend complex or trend equity complex. It's basically like a levered up version of doing our SMAs. So that's another asset class. They're basically the same. And then managed futures, which it just really, to be clear, what does that mean? Because that could mean 100 things. To me, managed futures means trading bonds and commodities long, short, based on trend, period. Anything else is not managed futures to me. So I'm doing trend following across basically the commodity bond complex globally. And then private long-term investments, so like private equity or VC, what have you. And then just my own business, Alpha Architect. So those are kind of like all the buckets, kind of from least risky to most risky at a high level.
And how do you think about it? I didn't see bonds, I don't believe, on that list. How do you think about bonds? I mean, do you think, given your long-term time horizon, you really don't have any need for bonds?
Yeah, I mean, I know this sounds so crazy because so many people are so anchored on bonds, and even we sometimes recommend them for behavioral reasons. But I really believe that bonds, like commodities, like Bitcoin, like a lot of things, they are tactical assets that you should only own with trend. I personally think that buying and holding bonds is absolutely crazy because, especially right now, because they're low return, they have terrible taxation. It just doesn't make any sense to me, right? So I'm all about owning bonds if they're in a trend, but why would I want to own, like, especially high duration bonds if they're not in a positive trend? Like, to me, that's just crazy. Like, what's the point? And, obviously a lot of people are learning that the hard way this year, but that just seems to be like an evergreen thing. Like, same thing, like, why would you ever own commodities, buy and hold? Like, it's insane to me why you would do that. Like, if they're in a trend, great, own them. If not, don't own them. Save your capital for like under your pillow or for wait for a trend to show up and then go allocate to it. So anyways, long story short, I think bonds are kind of nuts personally, unless you had a way to tax manage them. Then they would get a little bit more interesting. But just the fact that you got to give up half of the income associated with them right off the bat, it just makes them very unattractive to me.
There actually might be an ETF idea in there in terms of bonds and trend. Maybe there's something there for the future in terms of what could be done with that. When you look at equities, are you a big believer in using trend for most of your equity position as well, or do you think you want to have a significant sort of long-only sleeve that you hold of equities long-term?
Yeah, and I don't, so I do 100% trend following on all equity exposures personally. I don't do any buy and hold. If I wasn't in asset management, that might change a little bit because I'm so tied, obviously, through our revenue on a big part of our business is just tied indirectly or somewhat directly to just what the market does in general globally. And so obviously if the stock market as a global entity blows up 50%, our revenue doesn't go down 50%, but it goes down 20 or 30%, and we have a lot of fixed costs, so that would suck. So for me in particular, I just buy and hold equity is just a little bit too exposed. But that said, even if I didn't have our business, I still think that I would only own equity probably with trend following on it, just because as you guys probably know, we obviously know, like, owning equity outright is a great way to get your face ripped off ever so often, and losing half your capital, it's just not something I feel like doing. So I like trend following, but it's not for everyone, obviously.
And do you use valuation at all when you think about equities? I mean, I know we had you on last time. We talked about, we were kind of at the, right after the COVID bottom, and small cap value had gotten really cheap, and you talked about maybe putting some more money in that. And do you think about using valuation at extremes or anything like that, or do you really just stick with trend?
So I have my I guess I'd call it my tactical fun bucket, like where I can go be an idiot and like make calls and try to feel famous or whatever. I only do that with my retirement account, which is not a lot of money relative to like most of my portfolio. And that's the one area where I'll kind of use my gut instinct. And my claim to fame, my claim to infamy is I used to be a concentrated stock picker and lost my ass. But my claim to fame is that March 23rd, 2020, I said, I'm not doing trend anymore. I'm going all in on deep value. And I literally transitioned my retirement account from trend following to buy and hold deep value. And that was obviously like bottom ticking it. And again, that was just because, hey, these things are down 50, 60% in a month. This is crazy. The world's not going to blow up that bad. But again, I only do that in my fun money where I know I'm going to screw it up. In all my other money where I don't want to screw it up, I just use trend following to tactically time, allocations and what have you.
I do a little of that myself, and I think there's something to be said for kind of doing that in your personal portfolio, so you kind of get it out of your system. So like you're not attempting to do any of that for clients. You kind of just take your own money, a little bit of it on the side, and you can do this crazy stuff. And if it doesn't work out, that's okay. But you sort of get it out of your system doing it.
Yeah, it's a lot more fun as well, because it's just a lot more fun to be engaged in the day-to-day, market commentary, what's going on in the macro, what's going on with Russia. Like, even though all this stuff matters zero for your strategic allocation and how you should be investing, it's just too much fun. And you got to have something to kind of rub the itch. And that's what I do.
I want to come back to your list, and the second thing on your list, I believe, was real estate. And you obviously have your personal residence, but beyond that, do you do any other investing in real estate?
So I have in the past, and so right now, my real estate situation is a little bit different. So down in Puerto Rico, under this thing, it's called Act 60, which is like a tax deal that I'm on. You have to buy a residence here within 2 years. So I have to buy a house whether the rents were 10 times cheaper to rent versus buy or not. I have to buy. So I have a house fully paid down here because that's part of my deal. I have done down here in particular some strategic flips. But I wouldn't say it's not something I do. It's just because the opportunity presented itself and I was able to move quickly. But that was just a one-off. In general, I hate real estate because it's after you include the brain damage, the stress, the pain and anguish, the audit, the complexity, it's just not worth it to me. That doesn't mean it can't be great for some people, but I like financial assets that I can get rid of really quickly. I could see every day. I could understand. I could tax manage. I keep the fees down, and they're liquid. That's just a benefit to me. So real estate, I keep to a minimum as best as I can.
Can you explain the Act 60 more? Because I know there's significant tax benefits to living in Puerto Rico, but to be honest, I don't even know what they are. So can you sort of explain that?
Yep. So basically the nickel tour on it, and it gets pretty complicated fast, is a capital gain tax here is zero. So there is no capital gains, right? So once you come down, you get marked. You can't have zero basis in $1 billion asset and then live here a day, sell it, and not pay any tax. There's ways you can kind of do that, but it requires a lot of long-term planning. That said, the minute you're a PR resident, from then on out, any value you add in equity, either private or public, is zero. So there is no capital gain tax, which is obviously a huge benefit. And then the other benefit that's kind of a showstopper for me is your income or income that you can source to Puerto Rico is subject to 4% tax, and that's it. So it's not even subject to federal taxes. So if you're paying 50% marginal taxes between state, feds, down here you pay 4%. So essentially, in my case, I got paid a lot of money to live in a tropical island that's awesome, and it was just a matter of convincing the wife. So I would say it's a step change in one's ability to build wealth and get closer to retirement a lot faster than if you're a U.S. resident.
And just an aside, you've enjoyed it so far?
Yeah, I mean, I love it, man. It's I think it's awesome, but I'm not everybody. I'm obviously a little odd, but I think there's nothing's perfect. But as far as if I had to put together a package of things I like, right? Like great culture, great people, great weather, tons of adventure, tons of outdoor stuff, really cool people, and even at the very end of my list, you're not going to charge me taxes to live. I mean, to me, it's the biggest arbitrage, no-brainer that ever walked the face of the planet. But it's not for everybody, right? There's not a Starbucks in every corner, a Costco in every corner. There's not, Amazon doesn't deliver same day. It might take 2 or 3 days down here, and you might have to speak a little Spanish. But to the extent you're not offended by just different strokes for different folks, honestly, I think it's awesome. So highly recommend people check it out.
I think the only downside probably is going to be the lack of hills for the march for you.
That's the thing, dude. There's tons of hills down here.
Is there? I wouldn't really. Oh my gosh.
Yeah, there's more hills here. there's a massive mountain range that goes through the middle. There's a massive rainforest. It's the only rainforest in North America. This place is like hill century. It's like Hawaii, dude, like the Big Island. I mean, it's
that's wow. That's awesome. That's good for you. You're gonna be hitting it then.
yeah. I mean, it's humid. Yeah. Oh yeah. Training down here, my capacity to train down here is 10x what it was in Philadelphia out in the burbs. Like, I mean, it's on par with like Colorado. There's trails that you can go crazy around here, man. So you have all that down here. It's not flat. It's not like Guam or something where it's just a pancake. Like Puerto Rico's actually got massive elevation, differentiation, tons of ecosystems. It's a really interesting place, actually.
The private short-term bucket you mentioned is really interesting because that's not something I've heard of many people doing. Can you talk a little bit more about what you do there?
Yes. So again, this is something that's very specific to Puerto Rico, I think, because in the States, there's too much money chasing too many deals. And it's like a well-formed capital market. There's tons of transparency. There's, it's just too easy to arbitrage. We're down here, there's a true lack of capital. And the market's like, I wouldn't say it's corrupt. It's just way less opaque. There's way less data involved. It's really hard to source deals. And so, like, just for example, like down here, you can throw a rock and hit a 10% cap rate on residential real estate. Like in the States, that would be absurd. You would have to be in like, boarded up ghetto that, you might die if you walk in to get a 10% cap rate on like a residential deal. Down here, you can do that without even could stumble onto it. So it's just the need for capital is so much higher down here. And the opportunity to you fall into hey, I need 10, 15% short-term loan. And it's asset backed, and oh, by the way, it's tax free down here. I mean, it's not huge scale. They're like 100, 200K little one-off things, but if you can make 10, 15% after tax, asset backed lending, short term, I mean, why wouldn't you do it? So that's why I started doing that down here. And again, it's not like a big part, but it's just an opportunity that happens to exist down here, at least right now. So I've been doing a little bit of that.
Yeah, that's really cool. And the private long-term part, we had Meb Faber on the podcast, and he does a lot of that, but he's kind of done, a lot of small investments in a lot of different companies and tried to diversify his bets, and take advantage of the fact that in venture, you really don't know what the winners are eventually going to be. Like, what is your approach to that?
So my approach is, in general, to avoid that like the plague. However, we happen to run in this thing called ETF Architect, where I literally get to see every deal that comes to market. It's like the wet dream for a private equity investor, right? Like I get every deal. I know everything about this business. I run the platform. I know where all the bodies are buried. And so to the extent that like an operator needs capital, we're starting this idea of like, hey, let's start up this little syndicate. And so we just kind of started one with my buddy, Ray Micheletti. He's like Princeton PhD, been in the business for 20 years, long game player, and he needs some capital because he's not independently wealthy. So we kind of put together a little bucket together. He actually moved down to Puerto Rico, which made it even better. And so I just anticipate in the future doing that more and more, just because I am in a unique position to potentially help our own platform. And I kind of have like a lot of edge, I would say. So even though I hate private equity, I hate the liquidity, I hate all the cost, I hate everything about it, it's just, this is a weird circumstance where I'm going to probably start investing in a lot more ETF operators personally, beyond just our platform already invests a ton in them as well. But a lot of times they need like $500K or $1 million of just, risk capital to kind of fund their life, basically. So.
Yeah, when you kind of have like an inside look at these companies, I mean, that's a very sensible way to do this versus, kind of throwing money out there in a lot of different directions. Yeah,
I'm not paying 2 and 20. I'm not just hoping and praying someone knows what they're doing. Like this is a very controlled way of accessing this, ETF, basically the ETF growth of the ETF boutique market, essentially.
Yeah, by the way, given that you're a value guy like me, that if you're ever like throwing a ton of money at venture capital, I'll know things have gotten exceptionally cheap, and that's probably the time to go into it.
Yeah. No, we're a ways away for that. There will be an opportunity, though, to your point, because so much dumb money that got sold a bill of goods is chasing that right now. And Dan Rasmussen always has good stats, like talking about like, public company enterprise multiples versus private company. In the old days, obviously private was way cheaper than public, so there was an arbitrage when you kind of went from private to public on the IPO. Now it's flipped. And on what planet is private equity going to outperform public equity? Like, it doesn't exist. There's too much money chasing too few goods. And so at some point, that thing will blow up. And sure enough, there'll be opportunity, right? There'll be distress. There'll be opportunities. And so I'll let you know when we get there, but that could be 10 years from now, for sure.
Yeah, it may take a long time for everything to work through the system. The last question on the buckets is, how do you think about sort of sizing them? I mean, are there certain buckets here that you think are more important to you and you want to be the most significant portion of your portfolio? Do you kind of have a fairly equal weighting across these? I mean, how do you think about sizing these different things in your portfolio?
I mean, this is not news to a lot of people, but I guess it would be unique in the sense that when I tell you this, you'll think I'm crazy, but I think it's actually it makes a lot of sense that I'll explain. So I have two buckets, right? I have the one that includes my business, but that's weird because, 75, 80+%, depending on what you value the thing, is, my net worth. So all the rest kind of doesn't matter. But if we just throw that aside, because I just marked that at $1 on my personal books, and then I just kind of focus on my portfolio that's just the one I can look at every day. It's basically broken down into like exposure-wise. I actually have 50% of my portfolio in managed futures on a notional basis. A lot of that's like using leverage on top of equity, but it's like a global portfolio. About 50% is in trend-followed commodity and bonds. And that is designed to basically deliver crisis alpha. So when shit hits the fan, it's supposed to like go up, right? And it's supposed to counteract the deep risk that I take in the form of like, even though I trend follow the equity, I use long-term trend. So I'm eating a big chunk of the like equity risk premium there still. Like I need something that's a big enough exposure to actually offset, a 50% market drawdown. And you're not going to get it. Like, so but let's say you're concerned about tail risk hedging, like in a 50% market drawdown, like how in the heck is a 5% managed futures exposure or a 1% tail risk exposure going to offset a 50% loss in your equity book? Answer, it won't. It won't do shit, right? So the idea is like, hey, I need to balance off my big tail risk in equities, which is also known as short volatility bet. Like, you're short volatility because when volatility spikes to extreme levels, that thing gets destroyed, i.e. it's short volatility. And then I like to offset that with an equal component of what geeks call long volatility assets, or things that when actually the chaos begins, they actually make money and do really well. So I try to balance in my own way the amount of assets that are long volatility against short volatility, as opposed to being effectively 90% stocks and then 10% noise that doesn't really do anything. Like really, I'm just short chaos, right? Like I'll do well. Most people's portfolios are structured to do pretty well if nothing really bad's happening. But if something really bad's happening, they're screwed. And I obviously don't want to do that. So that's why, again, I take basically the easiest way to think about it is 50% of my portfolio is in long volatility kind of tail risk management structures. And then the other 50% is in trend follow equity. So basically our funds, so global value momentum with trend following overlays on them to protect against the beta component.
Yeah, and this gets back to something we talked to Medfavor about as well, which is, all of us are in the asset management business. So, and we have significant amount of our wealth in these, companies we own. And so we have significant beta to the market. I mean, if the market starts tanking, we're going to have all kinds of problems. And so it's very sensible, like in our personal portfolios, to have these things, with convexity, they're going to do really well on the other side if things are falling apart, and maybe in the asset management business in general.
Yeah, for sure. But to be frank, even if I sold Alpha Architect for some reason, and someone just gave me some huge pot of gold, or I don't even know what it would take. It'd probably take more than that. I would still run the portfolio like I do now. I might take off some of the trend following on the equity component, but I would always, regardless of the business, I would still maintain probably a 50% exposure to bond, commodity, trend follow, managed futures. Just because I feel like it's the ultimate diversifier, basically.
You have a lot of things in there that'll probably do well in this type of environment, as is, but I have to ask about it because it's probably been the most popular topic on our podcast recently, and this is the idea of inflation. So do you think about your portfolio any differently in a world of inflation? I mean, have you made any changes to try to deal with potential inflation in the future, or do you just sort of set up a robust strategy for all the different economic environments and kind of leave it?
Yeah, so, I mean, it's kind of a silly question, right? Like if you've built out a solid strategic investment plan under the guise that you don't know what the future will hold, like when the future unfolds itself, you'll continue to not know what the future holds. So why would you change the plan, right? Like that means you didn't have a good plan to start off with. So my portfolio is obviously designed structurally to be all weather, right? Like it is designed, and I will not change anything. There's nothing that I can even foresee in the macro landscape, anything that would change how I manage my portfolio, because it's already designed to deal with all the potential chaos and uncertainty of the future. I don't do anything different, because that's why I built it like it's built in the first place. It's heavily based on trend following, a lot of it, getting short bonds, your long commodity complex, and you've just been riding that trade, making money every day. And while the market, stocks and bonds have totally shit the bed. So I mean, I'm not changing anything. Why would you? It'd be crazy.
You're going more. You're allocating more to managed futures.
I'll just go. Yeah, I'm just doubling down on what I already knew worked. Why would you change anything? It's weird to me when people are like, oh, now I need to get this trend following stuff. I'm like, dude, like you needed trend following like 6 months or a year ago, but we wouldn't have known it was going to work 6 months or a year ago from now. You need it all the time. That's the point. Like you can't be chasing your tail after every big event or every big scare. It's just crazy to me that people operate like that. But I don't know. That's just how it's set up.
By the way, and just to be clear, this is an internal managed future strategy, or are you actually placing money with other managers? Okay.
Yes. No. So sorry. So yeah. So we do it internally. So we have tried to figure out how to deliver. So we've been running futures products for, I don't even know. Like we've been audited by the NFA 3 times, and it's probably been 8-9 years at this point. The issue with futures is they have a different regulatory body. And there's also a bunch of limitations within the 40 Act and to be able to leverage your capital efficiency. So I can't with a straight face, like we would have done it already, right? If I thought there was a way to deliver affordable exposure via 40 Act product to the public in managed futures, it would already been done, but I can't. So we do that internally via SMAs for like ultra high worth type people and just for our own account. Because that's really the most efficient way to deliver that exposure affordably and with the appropriate capital efficiency that come with managed futures. And that's just unfortunate. Like it'd be really nice if they updated the laws and made it a little bit easier to deliver these products, because managed futures, as you guys probably know, like or CTAs more broadly, most of the 40 Act products, they're okay, but they suck, right? They don't have enough volatility in them. You can't leverage them for capital efficiency because you got to be fully paid. It's just everything about them is just not great. So that your options are basically LPs or hedge funds, which charge 2 and 20, or you got to do SMAs. We don't charge that much on our SMA, but the problem is we have to run your own futures. So you'd have to have a huge account, right? You got to be super rich. So it's unfortunately one of the best exposures to have as an individual or an investor, but it's also the hardest one to get access to, after fees, after tax, after brain damage. So, it's one of those throw your hands up in the air problems.
Yeah, and to your point about like, the money flooding into like these sort of trend strategies after the fact. I mean, this is the hardest thing. We just had Adam Butler on, and we were talking about risk parity, and this is the hardest thing for your average investor in running these types of strategies. You have to be able to go to the cocktail party during the periods where you're underperforming, where you look very different than something like the S&P 500, and you got to be able to stick with it. And that's sort of one of the more challenging things of these. These strategies work really, really well over the long term, but you have to be willing to be different, in order to run it. And that's something I've definitely noticed about your portfolio is you definitely have a willingness here to look very different to sort of achieve your goals.
Yeah, I mean, it goes back to what's the underlying first principles in my portfolio, and actually what I recommend to people if they don't have weird behavioral or institutional baggage. Evidence-based, long-term, robust to chaos, right? And then for me in particular, I got to have skin in the game. Just so yeah, that's just part of the deal of being in our business. That's not obviously something that other people have to deal with because they may not be an asset manager, but it's that simple. Evidence-based, long-term, robust to chaos. Nowhere in there does it say strong relative performance to the S&P 500 over the next year, right? It doesn't say that. It doesn't say career risk focus. It doesn't say tracking error centric. It doesn't say, anything that pretty much everybody focuses on, because that's irrelevant to what my first principles are. And so that's why this portfolio, it doesn't look anything like anything that you would ever see in the the standard, hey, buy 60% S&P, 40% bonds and call it a day. That's just crazy. And unfortunately, people are learning that being long S&P 500 60% and long treasuries 40%, which was the greatest hedge fund 2.0 Sharpe ratio strategy over the last 25 years, like, it's not that easy, right? And this year you're down 15 to 20%, and your future looks pretty miserable. Just because I think it was a unique period where everyone who did that was, the best hedge fund manager of all time. And I can't see that repeating probably ever again in the future of investing. That seems nuts to me.
You did mention that of your investments, the bulk of the investments are in non-retirement accounts. And I'm just wondering, is there, when you think about kind of from this point going forward, getting more money into retirement accounts, is that something you sort of strategically think about, whether it's through a company 401k plan, or how do you kind of view that?
So remember, so my retirement plan is solved. It's called Puerto Rico, right? I have 0% capital gains and 4% income tax. And so I have zero incentive. Actually, if I have an old Roth IRA on a convert, but I don't want to do any of that stuff, right? Like, why would I? Like, and the big risk with retirement accounts that people never talk about is I think Roths are probably maybe a little bit less at risk at this, but it's easy for me to envision a world 20 years from now, because all you got to do is look at our budget. How much money do we spend? How much money do we take in? And we all know that, in the end, if too many people are voting for handouts, it doesn't end well. There's going to have to be a point, and I can see this politically, where people say, oh, you have over $3 million in your traditional IRA. We're going to start taxing that because you're too rich and we need to pay for all these damn bills. So I think the assumptions of a retirement account are fundamentally flawed, because I think there's a huge tail risk that it's going to be retroactively pulled. So I'm much more a fan of clean money and getting out of government structures, because I just don't trust them. And to give you evidence on that, that was on California's chopping block a few years ago, where they were going to literally charge you, pulling out of your income, California state tax, if you had over like $2 million squirreled away. And that's, and that sucks not for rich people, that sucks for the little guy, because he's usually the garbage can guy that, did saving, did all the right things, and just through compounding, he's going to be a millionaire in 30, 40 years. And those are the type of people, they're going to be like, oh, the rich people, we got to take the money from them. Like, guess what? The rich people already figured out how to go around that. We're not that stupid. And so I just personally, I don't think it's a good idea. I think it's a good idea because it's the best weapon you got. I think insurance is pretty good, mainly because they're hugely corrupt, and I believe in the corruption of the government. So I feel like that lobby will be around a lot longer and be the last one to ever get taken down. So there's a lot of, like, if you can get the fees down, there's a lot of interesting tax games you could play with insurance wrappers, like annuities, life insurance, and what have you. Those I think would be more interesting, retirement, because I feel like they're more insulated from government, renegotiations than a lot of other tax deals.
Point that you made earlier about, like, you immediately gave yourself like a huge raise by moving to Puerto Rico really resonated with me. And then I didn't even think about the implications of that. Effectively is like without any capital gains, it's equivalent to like a Roth IRA.
Yeah, it's on steroids. It's basically a Roth for all your assets. Yeah. And then the other one, the 4% deal, is like, it's like a traditional 401k for like 90% of your income, because you go from 50% to 4%. So it's equivalent to like deducting like 90% of your income, right? So I mean, it is like the retirement plan's like 10x. Not to mention you get a compound on all that too. So it's if you pull up a spreadsheet and you have specific financial goals, like a lot of people don't realize this, but like taxes are such a big cost. It's unbelievable. Like, it's not even like, Rick Ferry, he's a Marine, so I can talk shit about him, but he's a great guy. But, he's always arguing about like a BIP here or BIP there. But let's talk about the 500 BIPs let's talk about that. Like the U.S. government is the biggest fee you will ever pay by magnitudes beyond anything else in your portfolio. You could pay 2 and 20 all day, and that's cheap compared to what the U.S. government carry cost is, right? So that is fundamentally something that you have to solve, and that's something I learned from just hanging around a lot of rich people, being broke, is they're all rich because they figured out how to compound tax deferred and keep the actual money they make. But if you're just hitting W-2 and you're working your ass off and then you finally make it and now you're paying 50% of it back to the system, you're in the hamster wheel forever. You're never going to be able to get wealth, right? It's not going to happen. And so if you want to ever exit that path, you got to figure out a way to minimize your tax burden. And that's a business is a great way, right? Because that's basically tax deferred long-term capital gains compounding, which is awesome. So you got to either start a business, you got to do a structural move to like a place like I got. Really, those are your two answers: start a business, compound tax deferred, or move to a tax haven. Otherwise, you're screwed. Or be rich. But being born rich is also the best way to get rich. But unfortunately, most of us aren't in the lucky sperm club. So we got to do it the old-fashioned way. And so we got to think about other techniques to get there, because we just, we're not blessed with, being born into the family, I guess you'd say.
Is there anything you can think of with your portfolio that you're doing, the way that you're managing, that you wouldn't recommend to the average investor? And I'll give you like one thing that you may or may not agree with. So tell me, like the trend following. Like with trend following, there's two failure points, and we talked about this with Jim O'Shaughnessy. And this was more with active investing, but there's the failure point of the strategy underperforming and the investor making the wrong decision when the strategy is underperforming. And then there's also just what can happen with the overall market. The market can go down, and then the investor can make a bad decision just because of the losses. I mean, hopefully trend following helps avoid the worst of those losses, but then a lot of trend following signals, they actually aren't right and they get whipsawed, and you end up, if someone's looking at it that closely, they're thinking, well, what could I have done if I would have just stayed invested? So with trend following, is that something you think? I mean, I know you run trend following strategies within an ETF wrapper, so obviously you strongly believe in that, but do you think most average investors should be doing this?
So I do, but it's all about the assumptions, right? So my first principles on this thing is evidence-based, long-term, robust to chaos. All those basically imply discipline and understanding what the heck you're buying and why, right? And it's evidence-based. So if you go look, we actually did a post. It's called like trend following, the epitome of like pain or something like that, right? And we already know that if you trend follow 70-80% of the time, you're going to get whipsawed. So 70-80% of the time, you're going to hate yourself. But the trade-off is you're robust to chaos, right? And so for me, I think it's just a matter of, can you answer these questions? Are you an evidence-based investor? Are you long-term focused, or are you a benchmark hugger, right? Do you want to build a portfolio that's robust to chaos, or a portfolio that just, sounds like what everyone else has at the cocktail party, right? If you can answer those questions definitively, yes, I'm evidence-based. Yes, I don't care what the benchmarks are doing. And yes, I care about a portfolio that's 20-year worthwhile, not 2-year worthwhile. Then I do think everyone should have portfolios like that include trend following. However, as you guys know, and like that's fantasy world, because it says that, oh, we're all like nice, disciplined people that don't eat donuts and work out all day. Yeah, right. That doesn't happen. That's why, 80% of Americans are like obese. So the reality is, if you can't conform to my assumptions of being disciplined to the process, being evidence-based, et cetera, then yeah, that's probably not a good idea. You should probably just go buy 60-40 Vanguard funds and call it a day, and you'll never feel bad about it, because when it's blowing up, well, everyone's blowing up. When it's making money, you're going to say you're smarter than all the active investors, right? So that one I say it depends on the assumption. The only one that I would say, even with those assumptions, that's just not a good idea, and I'm just uniquely in a position to do it, would be that private equity component. Like I would not recommend anybody do private equity at all, even if you are evidence-based, long-term thinking, and robust to chaos. Because I think in general, in most circumstances, the fees, the illiquidity, the complexity, the taxes, all the baggage that comes with it, it's basically never a good idea. Except, again, in the unique case that I have, where, in small quantities with direct access to the deals, unique perspective on the business, it might make sense for me to do it. Arguably, that could be considered my worst investment idea, too. But trend following, I actually think, is a great idea for most people. The problem is they just need to kind of learn and understand and get educated in the dark arts of trend following, unfortunately.
To your point, I mean, you guys do as good a job of that as anyone. One of the things you'll see with a lot of investment managers, they'll kind of sweep under the rug the bad things that can happen with a strategy. You guys are very upfront about, like, here are all the horrible, awful things that are going to happen to you if you were to follow this strategy. And if you can't stick through it, you're not going to make it. You've done a really good job of flipping that around, I think, and really educating people about what your strategies are.
Yes, and that to me is just common sense, because it's not hard. Like, anyone with half a brain and Excel spreadsheet can go do back tests on trend following on every asset class that's ever walked the planet and be like, holy cow, I basically get most of the return with half the drawdown. I should do that. It's like a duh, right? The problem is that's not the hard part. The hard part is sticking to it in the behavior. And so that requires like a deep understanding, a deep endowment effect, and a deep appreciation for just how bad and just how ugly and painful this whole like relative performance and like careerist thing can be. Like, people discount that too much. And so, well, if you want to solve that, just run towards the fire, right? Like, let's just directly address the elephant in the room. This sucks. Like, buckle up, buttercup. That's just how life is. And we're just going to tell you how it is. And if you're cool with that and you understand it, well, guess what? This is the greatest idea that you'll probably ever run across. And welcome to the team. But if you can't get your head wrapped around it, like, it's not going to be a good fit. Even if it's the best idea on the planet, for certain people, it's probably the worst idea on the planet. And that's cool, all good.
You had mentioned that when you started investing, you were, scouring the Raging Bull message boards, looking for the hot microcap stock probably, and picking stocks and, learning the hard way about, trying to pick stocks qualitatively. But, when you think back to what maybe some of your biggest mistakes have been, but maybe more importantly, what you've learned from them, what would you sort of point to?
Well, that's easy. I mean, basically just overconfidence. So concentrating, my big downfall, like one of the reasons I got so excited about investing is, I made a lot of money with huge returns way early on, basically betting on like essentially what maps to penny stocks, like deep value, small micro cap value deals. It killed it, right? That's after 2000, the bubble breaks. And I didn't know this after the fact. I was just living through like the greatest small value factor run of all time. I just was in the middle of that thinking I was a genius, and it kept compounding on itself. And I kept getting more concentrated. I was 100% in like a handful of like less than 50 mil, small cap Ponzi scheme stocks, like Bitcoin investors today. Like I lived like a Bitcoin crypto person. And so I've seen how that rodeo plays out. And that's what happens, right? Like you have great success. You think you're a genius. You double down. This is the only thing that makes money. Now I'm all in on this one trade. And now I'm super concentrated in this one trade. And then you end up with like, what is your portfolio? Well, it's Bitcoin, Ethereum, and a few shit coins. And you look at people, like I don't look at people and say, God, they're crazy. I look at those people and think, I feel sorry for you, bro. Because I did that. Like I unfortunately I did the exact same thing. I understand psychologically how you end up in that position. But unfortunately, that same psychology of how you end up in that position is also how you end up not doing that in the future, and why your portfolio will look a lot more like mine, right? Like very diversified, tons of weird things everywhere, tail risk or balanced, like, it's just the nature of investing though. So yeah, and I'm not really sure you can tell people. They just gotta, unfortunately, get burnt by the fire and learn it the hard way like I did.
Yeah, I certainly had my share of those as well early in my career. Yeah, I wanted to, as we wrap up, we wanted to sort of discuss when we do these, we always want to cover the idea of, investments are not just necessarily things that produce great financial returns. And so we wanted to talk about, like, as an example, I bought a racing sailboat a long time ago, and, that's about the worst investment you possibly could make from a financial perspective. I mean, I think that thing, I pretty much just have to dump money into that thing on a regular basis, but I've gotten a lot of benefit from it in my life in terms of having my friends out there and you having a beer with them and doing those types of things. And I'm wondering if there's anything like that in your life, and anything where maybe it wasn't the greatest financial investment, but you feel like the benefits were well worth it.
Yeah, I mean, so the problem with me is I kind of grew up like a depression baby. And so like I was just cultured to not want to spend money because that always equalized pain and like having to worry about it even more, right? So, and I can't change my wiring. So even today, like I spend money on everything that I could possibly want. But the problem is and I don't know, maybe I just got a hard wiring issue, but I just don't want a lot of stuff that is expensive, right? Like what I like is I like sports and adventures. I like good food. I like good gear. But, nowadays, because of technology and efficiency with China, and like there's so much, variety out there, you could buy the best food, the best gear, the best exercise stuff, the best everything. What is it? It's an extra 10 grand a year or something. It's just, the problem is I haven't found myself engaged in an activity that's super expensive. I guess fortunately, like, and I would love to find one. I just by nature don't have any, man. Like I like golfing, but I live on a golf course. I pay my annual dues. It's expensive, but it's not crazy. It's like $5 grand a year. And I get unlimited golf, right? Okay, great. I go golfing. That's the only habit I have that's kind of a outreach. I don't have expensive taste, unfortunately. So I can't even find a way to spend the money and light it on fire. I would love to. It's just not my personality. I don't have anything I like to do that costs a lot of money, which is, it just is what it is.
Well, you're probably better off that way. They always say you want to be the guy that knows the guy that owns the boat, not the guy that owns the boat. So your situation is probably the better one than mine. You can go out anyway. Yeah,
and I love boats. I love fishing, but the problem is I hate working, right? And I hate the brain damage of owning assets. So for example, like fishing, right? I've always thought like, man, because I actually love fishing, right? Like I used to want to be a professional bass fisherman way back in the day. My uncle was a sport fisher in Cabo San Lucas for 40 years. Loved it. Obsessed with it. If I had more time, that's one thing. If I had more time, I might do a little bit more. But like I went out with a guy here, and yeah, he charges like for everything. Like it was like ended up being like $400 a person, but he does all the boat, all the cleanup, like everything. You just show up, drink beer, drink water, fish for Dorado, marlin, and have fun, and it's $400. And I'm thinking, like, for $400, even if it was $1,000, why would I want to ever do this myself? Like I would pay someone $2,000 to not have to take care of a boat, not have to clean the fish, like not have to deal with like getting the government licenses that, I go stand in line for 10 hours. Like I'd rather just rent it.
I think I saw the pictures of that day, that catch you guys had. There was all the fish on the table.
Oh yeah. We had. I call them Dorado, but because that's just what Mexicans call them, and I'm used to that from fishing with my uncle down there all the time. But a lot of people call them mahi mahi. I think that's Hawaiian or something. But it's the big green fish, and what it is, they got big like seaweed patches out here. It's called sargasso. It's actually a major problem with like the beaches and like the Caribbean right now. They're trying to figure it out. But what you do is you go find these sargasso patches like out, 5-10 miles out, and you literally just start trolling bait around them. And Dorado are like they're really into schooling. And so once you catch one on the troll, like you reel it up to the boat, and then all the other ones will start schooling on you. And so literally you take bait, they're right off the boat, you put it on the hook, throw it over, and you'll see them like go screaming by, bite it, and like start ripping out line like, woo! And like, it's crazy, dude. Like we literally had 3 of us in the boat, and at one point I was double fisting rods because like the captain's like, dude, I gotta go gaff this one, hold this line. So I'm like double fisting like Penn Internationals here, like trying to hold on to these damn Dorado. It was epic, man. And we just had to stop because we limited out. We're just like, hey, we don't want to fish the thing out. It was crazy. So there's good fishing.
Yeah, and those fish, like getting those on the boat, it's tough. It's like gives you a really good arm workout, and it's like physical. You're sweating.
Oh yeah. Big game those are Dorado. They're pretty small here, but if you're ripping like a 50, 60 pound wahoo, or if you hook into a marlin, they literally have chairs and like specialized belts, and it's hours, dude. Like my uncle's forearms. Like if you see his forearm muscle, he looks like Popeye. Because he's, from cranking the reels over 40 years. It's a serious workout. It's not like bass fishing or, trout fishing. It's, you use a bass for bait when you're out big game fishing. We used to drop, 5-10 pound tuna, as the bait for marlin. And you're like, that used to be the biggest fish I ever caught. Now I'm going to use it as bait. Like, this is good to go. I could get into this, man. Like, it's, big game fish is awesome. I love it. So if you guys come down here, we'll hit it. I'll take you out.
So we have one closing question. I'm going to ask it, Wes, and then so if you had to impart, and we didn't get a chance to ask you this when you first came on the podcast. So this is our new standard closing question, and you can go anywhere you want to go with it. So if you could impart one lesson that you have learned, from building your portfolio to the average investor, what would that be?
That one's actually pretty easy. I would just say know what you own, even if it's like delegated through an investment advisor. Like I think it's always a bad idea when the client's just like, oh, you're the investment guy, deal with it. I think fundamentally you have to know what you own, period. And then the second one is do whatever you can to keep the fees and the taxes to a minimum, right? If you just do those 2 things, know what you actually own and why, I should probably add that, and then keep your fees and taxes to a minimum, it's all good. And as far as investment philosophy, it's also simple. Buy cheap stuff, buy strong stuff, and follow trends. Like, I could do it in one sentence. So investing is frankly pretty simple. It's just people always, they don't follow the basic rules for some reason. It's crazy to me. in theory, it's easy, right?
Doesn't have to be overcomplicated. A lot of times, simple is obviously, can be better.
No, exactly. Simple's beautiful, and that's why there is beauty in like Vanguard, in the sense that at least people can understand what they know. The fees are very low, the taxes are very low through the ETF wrapper. So it abides by my basic guidance there, because they can check those two boxes, which is probably the most important boxes most people should have.
All right, Wes. Well, listen, thank you very much for joining us. This has been great. We appreciate you opening up your personal books, the financial advisory bill. Tell Katie that it won't be too bad when I send it across.
Yeah, fire it on over. The problem is it's not tax deductible, man. You have to charge me as a consulting fee or something. I mean, let's see. I'm always thinking about taxes, man.
I haven't added any value here. So, but if people want to learn more about Alpha Architect and follow you on Twitter, you can always. Where can they go? You can tell the audience here.
Yeah, just alphaarchitect.com. Or you can, on Twitter at twitter.com/alphaarchitect. And then if you want to launch ETFs, you go to ETF Architect. Those are the kind of three main places you can reach out to us.
All right, Wes. Thank you very much. We really appreciate it, man.
Thank you.
You got it. Appreciate it, guys.
Hi, guys. This is Justin again. Thanks so much for tuning into this episode of Excess Returns. You can follow Jack on Twitter at @PracticalQuant and follow me on Twitter at JJ Carbonneau. If you found this discussion interesting and valuable, please subscribe in either iTunes or on YouTube, or leave a review or a comment. We appreciate it.